If you are of the view that bond yields will come down closer to 5 rather than closer to 6, which means that in future the risk premium will come down and equity returns will also come down.
So risk premium is a return over bond, right? Now the thing is that paradoxically when the bonds rally, it typically happens, as you know, right? Because see, why will rates come down? It's only because there is some distress. See, today the PV sales are negative or very lowish.
3 to 4%.
3 to 4%. That is the best marker in India. India, very few data points, Nikunj, you could gauge the economic health through. PV sales is one. The import growth could be another. But I think most importantly, core inflation at 3% for 5-6 months. So that means what's wrong? If we are doing so well, then why there isn't a sufficient inflation? 3% is like lowest ever, and it's sustained for last 5-6 months. So why things are not pricier enough, so to say. So basically, it all suggests that there is a cyclical downturn is underway. Okay, that is the reason I'm thinking that the bonds will rally. Okay. That is the reason I'm thinking that RBI, as Fed had to do, right? Last week had to cut 50 basis point, even though market 90% of the economists presumed that it will be only 25, but yet they did 50, so they saw something. My sense is that Shaktikanta would also see something, that there is a sufficient slowdown, and it ought to be sort of flowed by actually cutting rates as much as possible. Okay. So my sense is that if US is going to get to 3% Fed rate, then we'll have to get to 5. But going back to your original point, that if rates are rallying, they're rallying for a reason, or should rally for a reason, which is economic slowdown. That does not coexist with EPS growth.
Okay. So if I have to again summarize some of our points here, I'll start with the beginning point. Asset classes, importance of asset allocation. 80% of the wealth is always created by the right asset allocation. And assets, you have to always look at your portfolio, the asset basket, what you have, where the excesses are. Historically high returns are there, you need to perhaps take some chips off the table. Where returns have been low, you need to start increasing the weightage. That is the simple meaning of asset allocation. But we move to part 2, which is that according to you, equities you need to be cautious, bonds you need to be bullish, and gold you need to be neutral. So can I say that for next 5 years, equity as an asset class is unlikely to give returns which are in line with historical averages? In the next 5-year return will be lower than historical averages, but for bond it will be higher than historical averages.
So if history were to have a rerun, then all that you need to know is if 5 years have been very good, the next 5 years would be rather bad, right?
Bad means negative returns, no returns?
No. It means very difficult to have negative returns for 5 years, right? But to ensure that an investor who put in money in 2019 over 10 years gets the same return as he would have earned in any point in time on average in last 30-40 years, because last 5 years returns have been so good and stellar, the next 5 year has to be muted to get to the median. So because you've earned 16-17% in last 5 years, you will have to end up earning 7-8%, right? So that the average is still 11% or 12.
But when everybody says, okay, this time it is different, India ka decade hai, golden decade hai, flows are coming, retail has just started coming in, won't that make India a special situation, stock, so to speak, and we will do better than the world?
Yeah, it's always good to bet India is special, as we did during COVID time, where I made this argument with you that it's a golden decade for India. At 8, 9, 10, 12, 13,000 of Nifty, arguing for that is one. But at where we are right now, to argue this when a lot of it already is priced in, and we know that India growth is now slowing cyclically. So therefore, it's not a time to get hot about this.
Then why should corporates come back to the bond market if the economy is slowing down? If you can see the slowdown, I'm sure they can feel the slowdown. Okay. If corporates are feeling the slowdown, they would refrain from investing. They would refrain from going to the bond market. So while there is merit in the big picture what you're sharing with us, I'm talking about on-ground activity. If the corporate is not feeling great, the private sector capex will take a back seat.
Yeah, but everything has inertia. These things take really, markets are like, too quick to heat and too quick to sort of lose momentum. So corporate have had some business plan. They will have to implement all of this for next 1 year, 2 years. Things will slow eventually, but that inertia will, that keeps sort of the momentum. So whatever business plan was there, if they were to raise money, if they had to require something, all of that is still in place. It's just that when equity sort of gets into a little bit of a turbulent weather, they sort of replace equity through some form of, high yield debt.
Do you think we are 6 months away from the cycle changing in favor of debt versus equity?
I think so that, debt cycle has already begun. Last year when we discussed this at 750, 60, even then I said that in a massive rally ahead for bonds. My sense is that we're in the midst of a sort of a massive rate rally cycle in India. But the equity haven't decelerated. They've done as well. Actually, from a risk premium point of view, have done wonderfully in last 12 months, more so in small cap, mid cap. But there is a little bit of a euphoria building out there. It's very, very difficult, Nikunj, as you know, to be excited about equity for what the valuations are today. And, for the revenue growth, for the kind of margin pressures that, lots of countries are beginning to face. What is happening in China, which can transport a lot of deflation. Very, very difficult to imagine that the manufacturing will do very well given what's happening in China. So all of these combined, it sort of makes a case for a cautious approach. It is still possible that next 6 months, continue to have this, merry run.
Happy hours may continue.
Happy hours may continue. But, see, one thing we know, right, in life, that these are cycles. Yeah. And no one knows where the peak of it. But it's our hard-earned money. Let's not take all the beer home, Let's leave some in the pub,
That famous line from Chuck Prince.
Yes, let's not dance until the music is on.
And the music stopped, he didn't realize.
Yes.
For Citibank, he didn't realize the music had actually stopped a year ago because of financial crisis.
Yes.
So coming back to a very basic question for someone who says, okay, Maneesh, there's a lot of merit in what you are explaining. So how does one participate? Buy a good corporate bond fund? Apart from investing in your funds, how can one really participate? Buy a gilt fund, buy a corporate bond fund. What should be an easy go-to strategy?
Yeah, so decently long duration funds, if you're a small investor.
They are called as long duration funds. I'm asking basic questions to a sophisticated investor.
Fund, gilt fund, any of these funds, I think will do very well. I think I would prefer income fund over gilt.
Gilt is when you invest in government securities.
Bond only. Income can do both AAAs and AA pluses. So for an average investor who is dialing in small amounts, it makes more sense to be there.
Should one invest lump sum? Should one do the SIP investing?
Bond you could do, no need to do SIP. See, bond inherently is not volatile. SIP is a protection for volatility. Bonds are not as volatile. So therefore you could do a lump sum there.
Okay. So it's a good time to do a lump sum shift from equity to bond market. And if you have gains here, maybe just take the gains, 10, 15%, 20% gains depending on risk capital and move into a corporate bond fund or a gilt fund.
Yeah, but always remember that all actions of yours should be programmed well. Since money is made when you do position sizing and stop losses in a certain programmed way. These knee-jerk reactions are never good. No one knows.
So what's the trade as of today?
So a programmed way would be that if you are invested in equity, then you sort of take 5% chips off, let's say, every month.
Okay.
So and move into long duration. So so if you have a lump sum money incrementally, I will not ask you to dial up equity at all and instead put money in bond. But if you are invested in equity, today is not a day to sort of press a button to get out completely. And so, those actions don't help ever. So move it slowly into something else which potentially is better placed and better valued today. So which is bond today. Okay. So for an average investor, who most are right now, who we are talking to, in a programmed way, get out of equity and move into long bonds.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.